Hi back, everyone. Welcome back to this session. As you remember, in the previous sessions, we had some concepts that we were using candles and we were combining candles and also swings. Now, we're going to continue on that concept and we're going to use the same concept in order to define our boundaries, our overbought, oversold zone, and we're going to use that for defining cycles. Now, to have a kind of review and flashback for the previous sessions concepts, so let's go with this one. As you remembered, we just combined 5 candles to make one 5-minute candle. And from candle 1 to 5, we were just using opening, as you see here, and close of the candle, as you see here. And the cycle goes up to maximum up price bouncing and maximum down price bouncing, which we defined higher time frame week and lower time frame week using these concepts. This cycle goes on and on in other just candles, and they're delivering us 5-minute candles. Now we're going to use the same concept, but this time we're going to focus on Gann swings, high time frame and lower time frame, especially Gann swings, and we're going to use this to define our boundaries and overbought, oversold based on the candle range. So now have a look at this one first. So if we go to, after defining our Gann swings and the lower time frame and plotting it, if you look at the first very high time frame candle, very beginning candle of higher time frame, so you'll see that we are going to just call it 0.1, and the low of the candle is 0.2. Now, if we just measure the range of this, so we're going to compare this range with third and fourth points, which are high wick and low wick of higher time frame. So we don't have many big differences. I mean, by big differences is that 2 times more or 3 times more. Okay, if it is 1.5, that's okay. So we don't see any big shift in the tendency of the market. We don't see any big shift in the liquidity change. And if we just want to find a roadmap, and we define our road using these, connecting this lows to lows and high to high, so we're going to have this road. If we define the mid of this road, so we're going to have upper part as our overbought zone and down part as our oversold zone. Okay, so what does it mean? It means that so when the price is coming to overbought area, it needs more energy to break through this whole liquidity that driving the price down. So it means that sometimes it reaches the maximum pressure, maximum amount of the energy it has in order to just continue. But because it cannot sustain it, it needs to go back and continue with the overall direction of the market. So the reason that it is coming up and going down, as you see on the chart, a natural way of moving market is by going up and down. So the reason is that there are some internal liquidities here, and also some of the sellers here, they're taking their profits. And these two groups of the people are their collective energy makes the movement a little bit have some pullback, and again, it continues its way down. So then we have some internal liquidity here. It needs, the market needs this energy and liquidity to drive the market down and break this lows. So now we're going to use this and we're going to have our map in order to walk through this jungle. Now, if we want to just define the other part here, now our third, and if you look at this, our third and fourth point will be our first and second point again. And now we're going to define our third and fourth point again and again till the end of this trend. Now, if we want to just connect the high of the previous candle with the high of the new candle here, so we'll have this trend line, let's say, and we'll have this line as well. And if we want to define the middle of it, so we have a road that is just turning a little bit and getting a little weaker in the slope. And so this part is going to, the upper part is going to be our overbought area, and the lower part is going to be our oversold area. This story continues. If I just extend this this trend line, you'll see that it's almost touching the highs of the other candles, like this one and the other one. So because the range of these candles, hasn't changed a lot. At least it hasn't changed 2 times of this range. Okay, so now that's why we're just extending it. But if you look at the range of this candle is almost double the size of this candle. So that's why it is breaking our trend line here. So then, after we just define the mid of this candle, this road, so this area is going to be our overbought and oversold area again, as we had it in the previous sections. So now, if we look at this range, end of this range, and the candle here has at least double the size of this range here. So Sometimes people like to have trend lines like this one. I don't recommend it. So, but if we want to do it now, if we have the first point and the second point as we did for this one, here is going to be our third point and the fourth point, right? But if we want to just connect these two together, so we don't have a proper place to just connect this line unless we're just putting a parallel line using point 2, 3, 4. We can just have a parallel line that defines our overbought, actually boundaries of overbought area, which is less valid than these ones because it doesn't rely on the fourth point that we need here. So because the slope of the mid has changed dramatically, it doesn't make sense to just try to make a channel out of a place that it is not possible to make a channel. So bear in mind that we don't want to just push and force the market to give us channels. So when we have channels, okay, we will draw it. But when we don't have channel and we have a lot of liquidity and we have a lot of momentum, so we never force the market to give us channel. So if we break this candle down, to the lower time frame, much lower than this one, for example, if these candles are for 15 minutes and the lower candle inside them are 1 minute, so maybe your 15 minutes candle should be broken to less than 1 minute candle. It should be 15 seconds, 20 seconds, or 10 seconds so that it gives you a neat channel. So you can find overbought and oversold of that channel. So now, if we just want to just continue with this, it could be like this, which, as I said, it is not as trustworthy as the previous ones. So then we have this area as our overbought area. So look, we have this area above red line. And again, we're going to just divide it in two. And this area is the best place, or best areas that we can look for sell, when you are trying to trade. Now, I'm going to give a very simple to follow method, but it's not a full method. So you need to just add a lot of things on that. But the basis of the concept is going to be this simple trading idea. So we're going to build on that one using boundaries, some area of interest, overbought, oversold zones, that what happens inside these candles and swings. Before we go on, let's go and dive deeper into this overbought, oversold. Maybe you are not comfortable with this trend lines, which you say that it is so old-fashioned, and some of the people are comfortable with market structure and this kind of concepts. So we're going to apply market structure break to define our overbought, oversold area. So if we have this swings like this one, so whenever we have a break of this swing, actually proper break is acceptable. Like what is the meaning of proper break? It means that we have a break using candle close. Okay, if we have this swing and it is broken by shadow, although it is a breakup structure, but it is not as strong as, it is not the way that we can trust it. Actually, it is if it is the break is using wick, it is a signal for buy in the reversal concept. But we have this here. We need to have proper break, which is called break using close of the candle, which makes this place safe for us to put our stop loss there. So now here again, now as you see, we haven't broken this area yet. This swing yet. Now again, it hasn't happened. Again, here it happens, but the breakout structure is not using a candle close. It's not a proper break. It is not a strong break that shows the momentum downside. So here we also have the breakup, not only this inner swing, also maybe a little bit of this swing, but it is also with shadow. So we're going to ignore this part as well. We still don't have any breakup structure here. And our last overbought, oversold area is here. Okay, from here to there is called overbought, oversold area. Now that here, we can see a breakup structure using candle close. So this overbought, oversold area is validated. Now we can rely on this area as protected, and we can just put our stop here if we want to enter the market, and or we can trail our stop from there if we want to just trail our stop loss behind this protected area. Now the same concept goes on. Now we're going to go and find that here this candle has broken this swing. We have this break here. As I explained it already, it is not proper. So now again, we have this one. It goes up and down now. And here we have a proper breakup structure. So we have this 1, 2, 3, 4 areas up, overbought, oversold, overbought areas for the sell. And if it was uptrend, it was oversold area for the buy setup. Now, if you look at this one, we don't have any breakup structure here. Nothing has happened yet. So we're going to wait for this one. It is possible that it goes down and it has a proper break, or it goes inside this area. So usually it goes and retests these areas rather than just directly going down, especially when you have this weak momentum. So if you look at this 1, 2, 3, 4, and let's say 5 areas, so if you want to find much better place of entry, it is not like here or there. Although all of these that where I'm supposed to get inside this trade, is it this area, upper part of overbought or sold area? Is it the lower part, or is it near? Am I supposed to enter the market using breakout candle? All of them are related to the market cycle concept that you are going to be taught in the future lessons. Okay, now here is the best area you can take your shorts on. And now look at these candles. Okay, I have plotted them on the chart. So close up the green candles in overbought or sold overbought area. Actually, here, look, overbought area. I didn't choose this one. I didn't choose this one or this one. The reason is they are below overbought or sold area. Because the reason that I'm showing this one, I'm going to give you a simple framework for any other strategy you want to use. It doesn't matter if it is based on ICD concept, if it is based on price actions of Albrook's, if it is based on any other liquidity concepts or RTM, whatever you want, just consider it should be kind of following this structure to be profitable. Now, look at these areas that we had. What were these areas? These were our overbought, oversold areas, right? Now, because it is downtrend, it is our overbought areas. Now that we have close of the candles in our overbought areas, before we move on to simple structure, have a look at these candles. I mean, the higher time frame candles close, and this one as well. Look, and this one, and this one. Okay, so these candles low break one after another. Okay, we don't have high break here at all. Okay, so then if you have to just higher time frame candle view, so where are we looking for sell? Whenever we have this shadow, I mean, if we are in third candle, so we have our 1, 2, 3. Okay, we have 3 candles here. So if we are in third candle, the retest of the previous, bar, this one, I mean, candle 3, is the place that we're looking for sell, because it is overlapping with our overbought area. The same here. If you look at now, this candle is our third candle, second candle, and the first candle. Our first candle's low is here, and our overbought area is overlapping with this candle's shadow. I mean, low shadow, low wick. The same concept here. If you want to just consider this one, 1, 2, 3. So this area is the best place that you can find your entry based on the candle. So you can have different kinds of views for that. It could be a higher time frame candles view for define your overbought areas. You can have swing point of view. It doesn't matter. You really just choose whatever you're comfortable with. For example, if you get rid of higher time frame candles here, so you'll see that. Okay, so if we want to just plot this line, I mean the breakout below of these candles, it has no meaning for us without having higher time frames candles, right? But as you see, they're overlapping with our overbought area here, right? Now, let's have the overlapping of swing points using dynamic ones and our, what do we call that? Let's say valid pullback, let's say overlapping, okay, overlapping of other ones. Now, if we just get rid of this, swings here, so we have, I mean, clear view of it. It is neater to see here. Now, these are our overbought areas based on our trend line, let's say, or channel, let's say, or whatever you like to call it. Now, and these ones, okay, as you see, these ones now are the way we just defined our overbought or sold area using market structure break or valid pullback break, whatever you want to just define, as far as it has the proper break of the market structure. So now, the simple trading idea is a candle close entry in the cycles overbought zone. Okay, now what is that? I'm going to explain it here. Now have a look at the overbought areas here. So I've just chosen overbought areas using this channel. You can use valid pullback ones. It doesn't matter. It's up to your preference there. Okay, because they are just almost 95%. They are just actually interchangeable. There, you can use them in any form that you like. It doesn't matter. So now, the first thing we are going to do is we are going to define our boundaries and our bat and our sold zone, that which is here. You can see that this area is much better. So then, in a downtrend, now as you look here, so we're looking for the green candles close, okay, and in our bot area. So we have green candles here, as I plotted in the previous one. If it was the uptrend here, if it was uptrend, we were looking for red candles close. So it is opposite. If it is downtrend, we are moving overall down. We're looking for green candles close in our bot areas. So here you can see them here, and I didn't, as I explained, I didn't choose this because they're not falling inside our bot area. Okay, so this one didn't fall, this one didn't fall, this one didn't fall, and it doesn't. So we're gonna measure the length and the range of this candle, this one as well, this one as well, this one, and this one, and this one, and this one. Okay. Now, if we call this range R, we're going to extend this line, okay, this range, and we're going to double it. Okay. And I'm going to say why we are going to double this. So the reason is we want to just put our stop loss at the end of this range. Okay. Here it is not at the end of the range because it is too long and it is too much of a, actually risk. And also here and there. So let's see if we put our stop loss here and we enter by the close of the candle, if it is in overbought area, especially in the yellow part of overbought area. So what will be the result of our trades as far as our target is before we just break market structure or another boundary? Okay, so now take sell, okay, in the close of the green candle here with 1 hour stop loss behind overbought, which is here. This is our 1 hour stop loss, and TP before counter overbought oversold. It means that counter overbought sold becomes counter overbought sold become oversold, and counter oversold becomes overbought. It means that before we break this protection, or let's say this boundary, so we need to have our TP. If our TP is bigger than our stop loss, it means that it must be must be more than 1. Okay, so here is our TP for the first one, which is way more than 1 hour. Here again, the same concept. Here the same. Why do we start from here? Because whenever we have in the live market, we have the close of market here. We have the close of the candle here. Close of the candle. You cannot catch this part. Okay, it's going to be risky. But whenever the time is up, you have this candle delivered, and you will have this close of it. You can just hunt this part as far as the stop loss falls behind and the target falls inside these boundaries. So the concept is so clear. So when you're just here measuring the range, so the stop loss must be protected behind boundaries, and target should not be protected behind boundaries, because we want our target to be filled, and also we don't want our TP to be filled and protected. So we're using these imaginary walls to protect them. So the same here and the same here. So now we have different kinds of, I'm going to show you these, how to we apply these concepts on the real chart, but it's going to be for the next session. Please go and practice them. So stay tuned till the next video, and let's